Hi, I'm Jason Rericha. In this video, we're going to talk about artificial intelligence and its impact on the financial markets. In particular, we'll look at the full AI supply chain, the investment questions it raises, and how valuations across the technology sector reflect these trends. AI has quickly become one of the most important themes driving markets today. While it seems simple to use an AI chatbot or an AI-powered tool, there's an enormous amount of complexity behind the scenes that makes it all possible. For investors, understanding the broader picture is important because AI is not just about a handful of well-known technology companies. It spans the entire value chain and has real implications on how portfolios are positioned. All right, first, let's talk about the AI supply chain. While it's easy to think of a few AI companies, this is only part of the story. At the foundation is hardware. Training the large language models that power AI requires thousands of connected servers running for weeks or even months at a time. Then, every time someone uses one of these models, that also requires significant computing resources. This is sometimes known as inference. The combination of training and everyday use is why demand for chips and related hardware has been so strong. Supporting all of the hardware are data centers, which are essentially large facilities packed with servers that run around the clock, requiring electricity, cooling, and security. Spending on data centers construction has accelerated sharply since the launch of ChatGPT in 2022 and has now surpassed spending on all other types of office construction. Finally, there's a software and application layer where the businesses are using AI to improve productivity and build new products. This part of the chain is perhaps the hardest to evaluate right now, since it depends on how effectively companies are turning AI capabilities into real results. Next, a central question for investors is whether the hundreds of billions being spent on AI infrastructure each year will eventually generate sufficient returns. As this chart shows, mega-cap technology stocks have delivered strong performance over the past several years, but with swings along the way. Some of that volatility reflects the uncertainty around whether the demand will keep pace with the investment. One concern that has emerged is that as AI models become more efficient, they require less computing power over time. However, history offers an interesting counterpoint here. When new technology becomes cheaper and more capable, that often lead to broader adoption and entirely new use cases. This is sometimes referred to as the Jevons paradox. Now, at the same time, markets have a long track record of overestimating how quickly new technologies translate into profits. The enthusiasm around internet stocks in the late 90s took over a decade to fully play out. That historical perspective is worth keeping in mind as AI continues to develop. Finally, it's important to keep an eye on valuations, but this is especially true today. As this chart illustrates, valuations for the information technology sector are elevated relative to their own history, but also the broader market. This is true for other sectors that contain large technology companies such as communication services and consumer discretionary. These higher valuations reflect strong earnings growth, but they also reflect high expectations for the future. It's important to remember that valuations are not a tool for predicting short-term market moves. Instead, they can help inform how a portfolio is balanced. Many other sectors outside of technology are attractively valued and also have solid earnings growth expectations. Maintaining exposure across the AI theme and other parts of the market remains an important consideration for long-term investors. We hope you found this information helpful about AI. If you have any questions about AI or how AI is in your portfolio, we're happy to have that conversation. And as always, healthy plan, wealthy life.